Hello guys, welcome to Bhavna's Online Academy. So in this video, we are going to learn the AS2. So in the part 1, we had already covered all the concepts, plus I had also provided you my handwritten notes. And in this second part, we are going to cover all the illustrations plus test your knowledge questions. In case if you haven't watched these concepts, I would request you to first go watch that so that your concepts are very clear and it's very easy for us to proceed with the illustrations and test your knowledge questions. Yes. So without any further ado, let's get into the video. So starting with your example 1. So in example 1, they say that there is a partly finished unit and the cost of a partly finished unit at the end of the year is 150 rupees. So by side we'll keep on writing. So there is a work in progress whose cost is 150 rupees. That unit can be finished by next year with a further expenditure of 100. That means they say that the cost of completion of such WIP is 100 rupees. If we further expend 100 rupees more, we'll be able to finish it. And the finished unit, once it has been finished, it can be sold at 250 rupees. So here they tell you that the NRV, net realizable value, or rather we can say estimated selling price of the finished unit is how much? 250 rupees. Okay. Next they say it is subject to a payment of 4% brokerage. So you have to do a cost of sale. So how much cost of sale you have to do? You have to spend 4% to make that sale. So it is going to be 4% of brokerage on selling price. The selling price is how much? 250 rupees. So 250 into 4%, it is going to be cost of sale is 10 rupees. Okay. Next, they are saying that assume that the partly finished unit cannot be sold in semi-finished form. That means you have to incur this cost of completion. Okay, and the NRV is 0 without processing is further. Okay, so they have told you to find out what is the value of inventory. So how do you find out the value of inventory? So here we are finding the value of work in progress. Let me give you a rough figure here. Okay, so you're going to do cost or NRV, whichever is lower. Okay, so here they have told what is your NRV. NRV, how do you find? What is your estimated selling price? It is 250 rupees. What is your cost of completion? Your cost of completion is 100 rupees, so reduce that. And what is your cost to sell? Your cost to sell is 10 rupees. So if you do so, you'll get 250 minus 100 minus 10. So 140 rupees is your net realizable value. Whereas what is your cost? Your cost is 150 rupees. The cost is 150 rupees. So you have to do 150 or 140, whichever is lower. So it is going to be 140 rupees. So here as you can see, then the value of inventory will be lower of cost or NRV, and it is going to be 140 rupees. Okay, I hope you understood this. Fine. Next you are going to see example number 2. So here they say that ABC Limited is there. It has a plant with a capacity to produce 1 lakh unit of product. Okay, per annum. That means every year it can produce up to 1 lakh. The capacity, the normal capacity is 1 lakh. Okay, we'll write here. Normal capacity, or what we call a standard capacity, is 1 lakh units. Okay, then they say that there is an expected fixed overhead of 18 lakh rupees. So the total fixed overhead cost is how much? 18 lakh rupees. Okay, and so here what will be, or in this case what is going to be your fixed overhead per unit? Your fixed overhead per unit, what was the formula? It was total fixed overhead cost divided by higher of what? Higher of either the actual production or normal production. Higher of actual production or normal production. Okay, so here in the first case what they say is there is no actual production given, so we'll directly take how much is the normal capacity itself. So fixed overhead per unit, fixed overhead here. So here the fixed overhead per unit is going to be 18 lakh, which is your cost divided by 1 lakh units. So 18 per unit, 18 per unit is going to be your fixed overhead cost. Okay, that we have found here. Okay, so next we are going to see case 1. Case 1, they say that your actual production is 1 lakh units. So here our normal capacity is how much? Normal capacity is also 1 lakh only. 1 lakh units only, and actual production is also 1 lakh units only. So whichever is higher, again it will come back to 1 lakh only. So 18 rupees will again be your fixed overhead per unit. Okay. Next they tell you that the actual production is 90,000 units. So here what you have to do, I told you, you have to follow 3 steps. Okay. So first step is what you have to do is you have to find out fixed overhead per unit. What was your fixed overhead per unit here? How did I tell you? Higher of actual or normal production. Actual is how much? Actual is 90,000. Normal is 1 lakh. So whichever is higher, again you pick 1 lakh only. Okay, so 18 lakh divided by 1 lakh. So here again your fixed overhead per unit will be 18 rupees only. But Here, since the actual production is lower, you have to follow the remaining two steps also that I told you in the concept lecture. First, find your fixed overhead per unit. Second step, what you have to do in second step, you have to allocate this fixed overhead per unit to your actual production. To your actual production, you have to allocate it. So it is going to be nothing but 90,000 units multiplied by 18 per unit, which is going to be 90,000 into 18. 16 lakh 20,000 is what you will be allocating to your cost of inventory. This figure will go into your balance sheet. This will go and get, this fixed overhead will go and get added to your inventory cost. It will go and get added to your inventory cost. Third step, I told you, find out how much is the remaining fixed overhead. Remaining fixed overhead will be nothing but 18 lakh minus how much the how much the actual production, how much the actual production has consumed. Actual production has consumed 16.2 lakh, correct? So the remaining will be 18 lakh minus 16 lakh 20,000. So 1 lakh 80,000. This is going to be what? This figure is going to be charged in your PNL account. This figure is going to be charged in your PNL account. So what were the three steps I told you? You have to just follow the same thing. First, you have to find your fixed overhead per unit, which you will find out by doing higher of actual or normal production. That units you have to take. So fixed overhead divided by higher of actual or normal production. So higher here was 1 lakh rupees. So by doing that, you found out 18 rupee. Okay. Then I told you have to allocate to actual production. So your actual production was 90,000 units. Multiplied by 18 units you did, and you got 16 lakh 20,000. This is what you have to add to your inventory cost. The remaining fixed overhead which is there, which could not get allocated to the actual production, which is 1 lakh 80,000 rupees, and you have to charge it to the PNL. So that is what is written here. See, 16.2 lakh, you know, this you have to, here wait, yes, the rest 1.8 lakh will be transferred to the PNL account. The 16.2 lakh you have to charge it to your cost of inventory. Okay, I hope you understood this. Third case is where your actual production is 1.2 lakh. So whichever is higher. So whichever is higher, 1 lakh is your normal capacity, 1.2 lakh is your normal is 1 lakh, and your actual is 1.2 lakh. So whichever is higher, 1.2 lakh. So this is going to be 18 lakh divided by 1.2 lakh. So per unit it is going to be how much? Per unit it is going to be 15. Per unit it is going to be 15. So this fixed overhead per unit, you have to, second step, you have to allocate it to what? You have to allocate it to the actual production. So first step, you found out the fixed overhead per unit. Second step, allocate it to the actual production. So actual production is 1.2 lakh. Yes. So actual production is how much? 1.2 lakh multiplied by 15, which is equal to 18 lakh. So 18 lakh you will charge to the cost of inventory. What was the third step? Find out the remaining fixed overhead. Remaining fixed overhead is how much? 18 lakh was your total. 18 lakh you have charged to your actual production. So 0. So nothing, no need to charge anything to your PNL account. So completely you have to include this fixed overhead on actual basis to the inventory cost itself at 18 lakh rupees. Okay. So like I said in the notes, if you follow these three steps, you will be able to arrive at the answer. So this was your example number 2. Next is example number 3. So example number 3, they tell that there is a trader who has purchased certain articles for 85,000. Okay. So here the cost of purchase is equal to 85,000 rupees. Okay. Next is he has sold some articles for 1 lakh 5,000 rupees. So here what he has done? He has sold some articles for 1 lakh 5,000 rupees. Okay. Next, they tell you that the average percentage of gross markup is 25% on cost. That means they do a profit of 25% on cost. Okay. Next, they say the opening stock of inventory was at a cost of 15,000. They say that the opening stock was how much? Opening stock was 15,000 rupees. Okay, done. Fine. So now what you have to do is you have to find out what is the value of inventory. Okay. So what I've always thought you is this value of inventory is found when it is found at each year end. That means you have to find out the value of your closing inventory. You have to find out the value of your closing inventory. Correct. So what is closing inventory? Closing inventory is nothing but your opening inventory plus your purchases minus your sales. If you do this, you will be able to arrive at your closing inventory. Correct. So here how much was our opening stock? Our opening stock was how much? It was 15,000 rupees. Correct. So opening was how much? Let me write it here. Yeah. So our opening was how much? Opening was 15,000. Okay, like I wrote here, correct? Plus you have to do purchases, plus you have to do how much? You have to do purchases. So how much did you purchase? You purchased goods worth 85,000 rupees. So plus 85,000. From this you have to reduce how much you have sold. How much you have sold. So how much you have sold? You have sold for 1,05,000. You have sold for how much? You have sold for 1,05,000. But one thing that you have to remember is when you are selling, correct? So when you are selling, this amount will include your what? This amount is going to include your profits also. So when you sell at a profit, correct? So this is going to include your profits also. Now either what you can do is you can either add profit to this and find out the closing inventory at including profit and then bring it to the cost. One method is you can find out the closing inventory including profit and then bring it to the cost. Or either what you can do is from this itself you can remove the profit and find out the closing inventory cost. Okay, I will do what is done in the book. I'll do what is done in the book. So in the book what they have done is, they are telling you that this 1,05,000 is including profit. So what you do is you bring this cost also including profit itself. This cost also you bring it including profit itself. So 15,000 plus 85,000 is how much? 15,000 plus 85,000, it is 1 lakh rupees. So this 1 lakh rupees is cost, but this 1 lakh 5,000 rupees is what? 1 lakh 5,000 rupees is including profit. Your sale amount is including profit. So first you bring this 1 lakh including profit. So your profit is how much? It is 25% on cost. Okay, so you have to do nothing but 1 lakh plus 25%. So 1 lakh plus 25% is 1 lakh 25,000. So this is your closing inventory plus purchases at including profit. So it is 1,25,000 minus 1,05,000. So now these both are comparable. So it is going to be 20,000. So this is what? This is your closing inventory, but your closing inventory should be valued at cost only, not including profit, correct? So since this is including profit, you have to now remove the profit. Okay. So how much is your profit? Your profit is 25 percentage on cost. Your profit is 25 percentage on cost. That means this 20,000 includes 100 percentage of cost plus it includes 25 percentage of profit. So this 20,000 is equivalent to 125%. Okay, so now if we divide by that, you will get your cost amount. So 16,000 is your closing inventory at cost. So your 16,000, you can see the figure here, cost of inventory, it is 16,000. So your 16,000 is your closing inventory at cost. Okay, so I hope you understood this, how I arrived at the value. Okay, so this was your example number 3. Now let's move on to example number 4, a quite simple example only. So we read that item by item basis you have to see, correct? So here they are saying that there is a cost, there is NRV, and you have to now find out the inventory values. They have given you item 1, item 2 and total. What did I tell you? You should not do at gross basis, I mean at total basis. You have to go item by item basis. So you have to see 50,000 or 45,000, whichever is lower. So it is 45,000, so that you have to write here. Next you have to see 20,000 or 24,000, whichever is lower. Cost or NRV, whichever is lower. So cost is lower, which means 20,000 is lower, that you have to write here. So 45,000 plus 20,000, 65,000 is your value of 65,000 is your inventory value. So this was all about your example 4. Okay. Next, let's move on to illustration number 1. The illustration 1 also, it's similar to the last example we did. So there are 3 products A, B and C. You have to find out the value of the closing stock. So you have items, what is their cost and what is the net realizable value. So what you're going to do, you're going to go item by item basis and you're going to see whichever is lower. So 40 or 28, whichever is lower, 28, 32 or 32. Both are same, so you can get it 32 itself. So 16 or 24, whichever is lower, 16. So it's going to be 28, 32 and 16. So 76 is going to be the value of your closing stock. Okay. Yes. Next is illustration number 2, where there is Exco, Exco Limited purchase goods at a cost of 40 lakh rupees. So the cost of purchase is 40 lakh rupees, and till March, that means till the year end, 75% of the stock were sold. So they had 40 lakh worth of goods, which out of which 75% were sold. That means on closing stock 25% only was left. So what is 40 lakh into 25%? It is 10 lakh worth of stock was only left with them. Okay, so this is the cost. Okay, here they are saying that the company wants to disclose the closing stock at 10 lakh rupees. The company wants to show it at 10 lakh rupees only. Okay, but here they are saying that the expected sale value is 11 lakh rupees. Here they are saying that the estimated selling price is 11 lakh rupees and there is a commission at 10% on sale payable to the agent. That means there will be a cost to sell. The cost to sell will be how much? Cost of sale, or cost of sale you can say, it will be 10% of 11 lakh rupees. So an extra expenditure you will have to include. Okay, so 11 lakh 10%, it is 1.1 lakh. Okay, so here what will be the NRV? The NRV will be estimated selling price 11 lakh minus 1.1 lakh, which is your cost of selling. It is going to be 9.9 lakh. So here how will you value the goods? The goods will be 10 lakh of cost or 9.9 lakh of NRV, whichever is lower. So you have to value it at NRV 9.9 lakh. So here the company is wrong in doing so. Okay, so the stock should be valued at 9.9 lakh. This is what you have to highlight here. Okay. Next is in a production process, the normal waste is 5% of input and 5000 metric ton of input were put in the process, resulting in a wastage of 300 metric ton. So here they are saying normally there is a wastage of 5%. Okay, they put in 5000 metric ton of input and there was a wastage of 300 metric ton. So this is a normal waste. Okay, so normal waste is 5%. So what will be the normal loss? So the normal loss would be 5000 metric ton multiplied by 5%, which is nothing but I think 250 metric ton. But how much total wastage has happened? 300 metric ton of wastage has happened. That means 250 is your normal wastage. Above that, an abnormal wastage of 50 metric ton has happened. Okay, I hope you understood that. Fine. Next year they have said that cost per metric ton of input is 1000 rupees. You have to say what value will you value this inventories. So here what you have to follow, I told you, number one, what you have to find, you have to find out your effective cost per unit. Okay, this step I have taught you in the concepts lecture and the notes also it is there. So effective cost per unit is how much? Your effective cost is what is your total cost. So your total cost was how much? 1000 per metric ton. And how much metric ton had you purchased? 5000 metric ton. So it's going to be 1000 into 5000, 1000 rupees per metric ton multiplied by 5000 metric ton divided by what is your total input. Your total input is 5000 metric ton minus what is your normal loss. Your normal loss is 250 metric ton. So you have effectively paid how much? 5000 into 1000, which is 50 lakh rupees. 50 lakh rupees for 4750 metric ton. So effectively you have paid 50 lakh rupees for 4750 metric ton, which means you have spent around 1052.63 1052.63 rupees for per metric ton. This is your effective cost. Second step, you have to find out how much is your abnormal loss. Your abnormal loss is how much abnormal loss you have made of 50 metric ton. Okay, here we found out, right? 50 metric ton multiplied by what is the effective rate? It is 1052.63. That means you have into 50. Yes, so here you have around 52,632. This is the amount of abnormal loss. This is the amount of abnormal loss. So whatever remaining amount is there, remaining amount is 50 lakh rupees minus 52,632. Okay, which will be 40 once again, yes, 49 lakh 47,368. So this is the amount that this is the amount that you're going to charge to the inventory. So this is the amount that you're going to charge to the inventory. So here first you found out the effective cost per unit, which was 1052.63. Then you found out how much was the abnormal loss, and whatever remaining value was there from the total, after deducting your abnormal loss, the remaining amount will go and get included as a part of your inventory. Here you can see, so the total value of inventory is 49,47,668. So this is why I told my notes will be very helpful, because all these question points I have jotted it down into steps, so it will be helpful for you to solve it. Okay, next let's move on to illustration number 4. So illustration number 4, here they tell you that you have to again value the inventory. There is a material cost of 200 rupees, direct labor of 40 and direct variable overhead of 20. Okay. And then they tell you that there is a fixed production charges that they have incurred and the normal working capacity is 2 lakh kgs and the fixed overhead cost is 20 lakh rupees. Okay. Here, then they tell you that there is 4000 kgs of finished goods in the stock at the year end. Okay, fine. So you remember we read about cost of conversion, that what and all will get included in cost of conversion. Your material cost will come, direct labor will come, direct variable overhead will come. So all these three costs will come. So it is going to be 200 plus 40 plus 20. So it's going to be 260 rupees plus you have to do fixed production overhead. That what will happen? You will find out what is the per unit cost. So here you usually what you do? You usually do what is the total cost and you divide it by whatever is higher. Actual cost or normal cost, whichever is higher. But here, I mean, sorry, actual capacity or normal capacity, whichever is higher. But since here only normal capacity is given, so you're going to do 20 lakh rupees divided by 2 lakh, which is going to be 10 rupees. Okay, so this you can add another 10 rupees to the cost. Fine. So your total is 270 per unit. So this 270 per unit, if you multiply it with 4000 kg, so this is your closing stock. Okay, so your closing stock is how much? 4000 kg. So if you do 4000 kgs multiplied by 270 per unit, it is going to be 10 lakh 80,000. 10 lakh 80,000. So this is going to be your, yes, here you see this is going to be your value. This is going to be your value of finished goods. Fine. So this was all about your illustrations and examples. Now let's move on to practical questions. So practical question number 6 is similar to one example or I think illustration that we solved. So there is a normal wastage of 4%. The company has used 12,000 metric ton of raw material costing 150 rupees. At the end, 630 metric ton of wastage was incurred. Okay. So here they are telling there is a normal wastage of 4%. There is a normal wastage of 4% and there is 12,000 metric ton of waste. Okay. And they are telling that they had generated a waste of 630 metric ton. Sorry, there was 12,000 metric ton of input and they had generated 630 metric ton of waste. Okay. So here first you have to find out how much is the normal loss. So here first normal loss is going to be 12,000 metric ton multiplied by 4%, which is going to be 480. Let me check this once. Yes, so which is going to be 480 metric ton is your normal loss. So how much is your abnormal loss? Abnormal loss will be what is the total waste? The total waste is 630 metric ton minus what is your normal loss? 480 metric ton. Okay, normally you should only have done 480 metric ton of waste, but you produce 680 metric ton, 630 metric ton of waste. So extra 150 metric ton of waste you have produced, which is your abnormal loss. Okay. Then they tell you that yes, then you have to just find out, the treatment of normal loss and abnormal loss, and also find out the amount of abnormal loss. So the amount of abnormal loss, how will you find out? First, you have to find out what is the effective cost per unit. The effective cost per unit is going to be how much? It is going to be your total cost. Your total cost is 12,000 metric ton of input you had purchased for 150 rupees divided by what is your total units. Your total units was 12,000 units, out of which how much was your normal loss? 480 was your normal loss. So this is going to be 12,000 into 150, which is 18 lakh rupees was your total cost, divided by how much metric ton did you pay? 18 lakh rupees. Effectively for 11,520 units you had paid. Effectively you had paid 18 lakh rupees. Okay, so this is going to be 156.25 rupees. 156.25 rupees. Okay, so this is your effective cost per unit. Okay, this is your effective cost per unit. Fine. Second one, we have to find out how much is the abnormal loss. Your abnormal loss is how much? It was 150 metric ton was your abnormal loss, multiplied by what is the effective cost per unit. This is 156.25. So your abnormal loss is 23,438, 437.5 or 438. So this is going to be your abnormal loss amount. Let's go and see the answer. Question number 6. Yes, question number 6 here. Abnormal loss is 23,437.5. Okay. So this will be charged to the statement of P&L. I hope you understood, and the remaining whatever is there, no, the normal loss, this will be included when you are determining the cost of inventories at the year end. Okay. So I hope you understood this. So now let's move on to the next question. Question number 7. So here it says that Mr. Mehul has given the following information related to the items forming part of your inventory on the closing date, that is on 31st March. Okay. His factory produces a product known as product X using the raw material A. So here what they are doing, there is a raw material A which they are going to process and make it into the final product X. X is the FG year and A is the RM year. Okay, fine. Next, they have told that 600 units of raw material A are purchased at 120 rupees and the replacement cost is 90 rupees. So, here what they are saying, for the raw material A, you have two things given, one is cost and one is replacement cost is 120 rupees and replacement cost is 90 rupees. Okay, let's read the next information. Then they say that there are 500 units of partly finished goods, that means WIP, work in progress, they are yet to be finished. Okay, in the process of reducing X and the cost incurred till date is 260 per unit and they can be sold. Here the units can be finished next year by incurring an additional cost of 60 rupees. Sorry. Yes, so here they are saying that, wait, RM they said there is 600 units. Okay. WIP they are saying that there is 500 units of work in progress and until now they have incurred a cost of how much? 260 rupees and they are saying they have to further incur a cost of completion of how much? 60 rupees to complete it, to make it into a finished good. Okay. In the next one, they are saying that there is 1500 units of finished product X and a total cost incurred is 320 per unit. So here they are finally saying that there is 1500 units of finished goods and a total cost of how much? A total cost of 320 was incurred to complete it and plus an expected selling price is 300 rupees. Here they are saying the NRV, expected selling price, here nothing because no other information is given, no, about your what. Um, Wait, let's write it as estimated selling price itself, so it's easier for all of us to understand. Yes, estimated selling price. Okay, estimated selling price they have said is 300. Now what you have to do is you have to determine how much each item of inventory will be valued. So now each of its value you have to find out. Okay, so first let's start from the finished good itself. Okay, so here for finished goods, what are you going to do? You're going to do cost or NRV, whichever is lower. Here when you're calculating the NRV, it's already a finished good, so cost of completion will not be there. And the other one is cost to sell. Cost to sell, no selling expenses are also given, so directly this estimated selling price will now become its NRV. So it's going to be cost or NRV, whichever is lower. What is lower? 300 rupees is lower, means NRV is lower. So here FG will be valued at 300 rupees per unit. Okay, so now we had read something about raw material. If you remember, we had read that in case if the finished good is being, finished good is if it is being, if the selling price, once again, yeah, if the selling price is less than the cost, then in such case what will happen? This is going to be a bad finished goods because it is not even able to recover its cost or its profit, correct? So in such case your raw material will be valued at what? It is going to be valued at cost or replacement cost, whichever is what, whichever is lower, correct? So here you have to value a raw material at cost 120 or replacement cost 90, whichever is lower, so it is going to be 90. So raw material you are going to value it at 90 rupees per unit. Okay, next finally comes your WIP. So work in progress, what is your cost? Work in progress cost is 260. What is the NRV of work in progress? That means here this is the most important point of the sum. Here you have to remember that you have to take the net realizable value of work in progress, and net realizable value of work in progress, how will you find out? It is going to be estimated selling price minus how much cost you'll take to complete it minus the cost of sell. So cost to sell, nothing is there. Cost to complete it is how much? 60 rupees. What will be its estimated selling price? So its estimated selling price will be same as that of the FG. It is going to be same as that of the FG. So 300 rupees. So 300 minus 60, 240 rupees will be its NRV. So it's going to be cost or NRV, whichever is lower. So it's going to be 240 rupees. So work in progress, let's write it here, is going to be 240 rupees per unit. 240 rupees per unit. Okay. So I'll write it here. No, raw material, work in progress, FG. So raw material, what we wrote, it was 90 rupees. FG was 240 rupees per unit. Sorry, WIP was 240 rupees per unit, and FG was how much? FG was, yeah, 300. FG was 300 rupees per unit. Now let's multiply it with the number of units. So raw material was 600 units. WIP was 500 units and finished product was 1500 units, and you will arrive at your finished final answer. So let's do 900 into 654,000 plus 240 into 500, which is 1,20,000, and 300 into 1,500, 4,50,000. So it's going to be 6,24,000. So it's going to be 6,24,000, and this is how they must have also solved it. Yes, you can see here it's 6,24,000. Okay, so the main catch here was about what? About the NRV of WIP. Otherwise, I think other all parts you would have gotten it right. Okay. Now let's move on to the final test your knowledge question, which is question number 8. So here they say that there is a on 31st March, that is on the year end, there is a business firm. It finds that the cost of a partly finished unit. Partly finished unit means WIP is 530. Okay, so they say that the cost of WIP is 530. Okay, and the unit can be finished by an additional expenditure of 310. So here they are saying the cost to complete will be how much? 310. Okay, next they say that the finished unit can be sold for 750 subject to a payment of 4% brokerage on selling price. So here they are saying that the estimated selling price is 750, and the cost of selling is 750 into 4%. 4% of 750 is how much? It is going to be 30 rupees. Okay, fine. Next, what happens? The firm seeks your advice regarding the amount at which the unfinished product should be valued. So you have to tell them what should be the value. Okay. So, like we read about the same thing, correct? So, WIP, what is the cost? The cost is 530 rupees. What is the NRV of WIP? You have to first take estimated selling price, which is 750 rupees, minus what will be the cost to complete. It will be 310 rupees, minus what will be the cost to sell. It is going to be 30 rupees. So which is going to be 750 minus 310 minus 30, 410. So you have to now tell whichever is lower, cost or NRV, whichever is lower. So it is going to be NRV 410 rupees. So you have to value your WIP at 410 per unit. Okay, so now if you're going to come down, it's going to be 410 per unit. Okay, so yes guys, so with this we have now completed all the questions of AS2 successfully, and I hope you understood. And if there is any doubts, you can leave that below in the comment section below, and if there is any other video request that you have, you can also leave that in the comment section below. See you in the next video. And also, in case you need the notes of this AS, it will be available on my Telegram channel, and the playlist of this AS series will also be linked in the description box below. Do check out that too. Thank you so much.